Met. I'm the president for the Rotary Club of Harrisburg, and I invite you to join us for a traditional luncheon meeting, service on a Monday, or Rotary alternate meeting. Everyone's invited, and that means you. Check out our website or Facebook page for more information.
Thanks, Beth. On behalf of the program committee, I'm excited to introduce Marc Dinacci. And before I start, I want to thank Nora Havik and Andy, who helped us procure Marc today for our meeting. I sat next to Marc and I asked him, this has got to be, we're only what, 10 days into 20, this has got to be a highlight for you in 2013. It's like, well, I've been to the Rose Bowl and I saw Penn State play at the Palestra this weekend. So it's the third best thing he's done so far this year to come speak to us. Marc's got 30 years of experience in investments in the markets. And the program committee asked him to speak because we wanted to know what the heck is going on. Don't we all, right? Our investment portfolios are down, jobs are up, workforce is up a little bit. So this is unprecedented what's happening. And Marc's going to help us do that. He's been with Wilmington Trust since 2015. And before that was with JP Morgan Private Bank for nearly 14 years. He is an esteemed graduate of Penn State University, lives in Westchester, where his most important job is he is a volunteer soccer coach at Westchester Henderson High School. So the floor is yours, Marc.
Thank you. And I have to say, I really do feel at home instantly. Matt is from Westchester, and you're a fellow season ticket holder at Penn State. And anyone who has a daughter with a Lululemon habit, I can commiserate with. So I know how you feel. So thank you for the invitation. I appreciate the audience, and I was asked to speak to provide an economic overview. But I think today, anytime we talk about what's happening in the world economically and in financial markets, we need to retrace the last 2 to 3 years, because where we are today is entirely attributed to how we got here. It is exactly 3 years ago this month when COVID became COVID. And the world changed and shutdowns became a reality for the world. And so what I want to do in rapid time is retrace what just happened in the last 3 years, what we're living through right now, risks that we see to the economy and to global markets, and also what our outlook is for the coming 12 to 18 months. And I think I'll give you the punchline first, which is that we expect from an economic standpoint a mild recession, and a mild recession could be short and shallow. This is not a repeat of the financial crisis of 08-09. And there's a lot of things that this is not, but there are a lot of things that this is going to be different, because there's so many mixed signals in terms of what's happening in the world today. I'm going to be short on predictions. In fact, John Kenneth Galbraith, the famous economist, is notorious for having said that the only function of economic forecasting is to make astrology look respectable. So I will preface everything I say by saying nobody really knows exactly what's going to happen, but this is about what might be reasonable to expect as the Fed finishes this inflation fight. And this conversation will begin and end with talking about inflation. And I'm going to talk for maybe 15 minutes or so, and then open it up to questions. Hopefully we can make this interactive. So how did we get here? So 3 years, of course, ago this month, COVID changed the world economically and otherwise. And so as a result of that, everyone knows that there was an immediate crash in markets, followed by an almost immediate recovery. That all happened in about 6 months, which was extraordinary in and of itself. But the response by governments around the world was twofold. Not only did the Fed and central banks around the world go back to zero interest rate policy and quantitative easing, this time what was different than the experience during the financial crisis was that the fiscal response was equally large, if not bigger. And this is important because those are the inputs that have created what is today the inflation problem that the world is living with. So how do we unwind all of that is the process of the Fed raising interest rates and pulling back on quantitative easing, and now this balance sheet reduction. So 2020 was a shell shock year It was a story of rapid decline, rapid ascent. 2021 was a year of continuing increases in asset prices across all categories, which include real estate, stocks, and bonds, which translated to record low interest rates across the yield curve. Crypto assets, which I'm not really going to give any attention unless someone wants to ask me about later. We don't consider that an asset category per se, but all assets experienced incredible inflation and reflation. So you go to the end of 2021, record levels across all categories, and then the Fed decides about this time a year ago that inflation is a more persistent problem than what was anticipated. Therefore, they have to begin raising interest rates and tightening policy a full year ahead of what their original schedule was. This, of course, led to the worst year in financial markets since the financial crisis in 08-09. And what was not only so bad for financial markets, everyone knows the stock market was down, but for those of you that are investors, you also know that bond markets also had their worst year in 42 years. And that is directly a function of interest rates going up and prices going down, to the point where we received exactly zero diversification benefit from any fixed income or bond investments. So you add it all up for the balance of the year, most investors are experiencing 15 to 20% declines in their portfolios. That's the bad news. The good news is that as this Fed tightening cycle starts to get closer to its end, which most people are expecting and hoping will be within the next 3 to 6 months, this is when things start to stabilize, the economic transition can be a little smoother, and things can start to improve. So that's how we got here. In terms of the major risks that we see to the economy today, number one is inflation, persistent inflation. On that point, the good news is that inflation is starting to decline. And this is an important point because when we talk about disinflation, it's not deflation. Prices aren't going down. It's simply about the rate of increase slowing. That is the most important point, and that's exactly what Jay Powell, the chairman of the Fed, is focused on, getting back to this 2% target. 2% target is somewhat arbitrary, but it is a target that most central banks around the world use as what is deemed the acceptable rate of inflation so that they can stop the tightening. Inflation is number one. The second problem is still COVID. This is more a China phenomenon at this point. Many of you know that China is just now reopening the economy, which has its own implications for inflation, because a lot of pent-up demand that has not happened the last few years is about to happen. The price of oil going up, all of these types of things are going to have real impacts over the next 6 to 12 months. The war in Ukraine is the war in Ukraine, but the bigger knock-on effect is about the impact it has on energy markets. The impact on energy markets has been somewhat drastic, although the worst case scenarios of European gas shortages and people freezing in the cold hasn't really materialized, primarily because weather has been much warmer than anticipated. And so that is still a problem, but it's a problem that's being remedied by a real-time reorientation of global energy supply chains. And the supply chain phenomenon broadly is also still a major risk to markets and the economy, but that has also started to improve, as evidenced by lower semiconductor prices, if not a semiconductor glut, and also shipping container rates have declined back to pre-COVID levels. So these are all things that 18 to 24 months ago were major economic problems that are now gradually starting to get a little bit better. At the same time, political dysfunction, which we've talked about endlessly, that is also showing some signs of improvement, if for no other reason than a split government we view is going to have a benign impact on the back and forth between policy objectives. So at least for the next couple of years, we envision that a split government will have a relatively neutral effect on economics. Now, those are the risks we see to markets, and what you what you may be hearing are some elements of positivity. And I'm not here to paint the picture that everything is fine, because it certainly is not. But the main point is it's mixed. And so I have described the current state of the economy as the yeah, but economy. So if I told you 5 good things that are happening today, most of you would probably say, yeah, but. And that's true, because there are a lot of counterfactuals and there are a lot of things that aren't right. But the good news is, as inflation starts to decline, many of the things that have been problematic, we expect should start to improve. And as you look at the news today, I've been giving people 2 bits of advice. One is read the newspaper from back to front, because the good news is on the back page. So read from back to front. And the second thing is that divide all economic and other news into 2 broad categories. If it's inflationary, markets have been receiving that news poorly. And if it's disinflationary, markets have been receiving it favorably. That's a little bit of an oversimplification, but recently that's been exactly what has been happening. So as you are overwhelmed, if not confused, by all of the different news that you see on a daily basis, just ask yourself a simple question. Is it inflationary or disinflationary? And typically markets will go up or down based on that. And so recently, as the news has been a little better, markets have improved in the short run. Now, that does not ignore the reality that markets are still at very, very low levels versus last year, minus 18 to 20%. But I think fundamentally, and Ryan alluded to this, is that there's a lot of mixed indications. The unemployment rate today is still only 3.5%. We see a lot of headlines recently about big tech layoffs, white collar layoffs. However, many of those workers are quickly finding new jobs. And so these are good things that speak to the resilience of the U.S. economy and the dynamism of the U.S. labor market. Also, the housing market is slowing, but it is certainly nothing like the financial crisis where property values are declining. This is another disinflationary story. So instead of housing prices going up 10 and 15 and 20% in certain markets, now housing prices are going up 3 and 4 and 5%, which I think many of us would agree is a much more sustainable rate of increase than these increases the last couple of months or last couple of years. So labor markets are still tight, as evidenced by the unemployment rate. Although we are starting to hear anecdotally that business owners are having better success finding and hiring workers and retaining them, but it is still a problem. And this is why I say there's a lot of back and forth counterfactuals. It's yeah, but. So it's not perfect, but it's getting better. So labor, housing, these are the major economic factors that we follow. They seem to be progressing directionally in a good way. Now, the problem is, as mortgage rates have gone up, almost more than double, today mortgage rates are 5.5 to 6%. That is having the intended consequence of slowing down the housing market. This is all by design. So for those people who are fearing this economic collapse, the world is in a much healthier place than it would otherwise be. So if consumers did not have strong balance sheets, which they do, if banks were not as well capitalized, which they are, then this rise in interest rates would be much, much more harmful. But the beginning health of the economy was much stronger to withstand what has been happening for the last year. Just to put this in perspective, if you think about what the yield curve and interest rates were about a year ago, there has been a roughly 350 basis points increase, 3.5 percentage point parallel shift upward in the yield curve in the last year. So a T-bill a year ago was effectively 0. Today, those rates are over 4%. That takes some time to get your head around. So it's just different, and it's been fast, and the rate of change is what has created so much disruption along the way. So the other real problem is sentiment. So we have this, there's the yeah, but economy, but there's also this emotional recession. So whether or not there's a recession, at this point is academic, because financial markets have already priced in, on average, a recession. So at this point, everyone is anticipating an economic slowdown. The extent to which it either is slightly positive or slightly negative, to me, is really beside the point. Investor and consumer sentiment, as measured by the American Association of Individual Investors and the University of Michigan survey, which goes back to 1952, that data recently has never been worse than it is today. And so that just gives you a sense of how much of a malaise and how much negativity there is, so that when inflation starts to come down, this is exactly when economists feel that markets and sentiment will start to improve. And so we're already seeing evidence of that, the early signs of that. So instead of high single-digit inflation, it's now mid-single digits. Later this week, there's another CPI report, I believe, comes out on Thursday or Friday. Another thing to watch for is fourth quarter earnings, which is going to obviously have a big impact on stock market response. But valuations are fair. So the one benefit of stock markets having declined 20% last year is that multiples are now exactly average based on historical metrics. So markets are not overvalued, they're not cheap, they're just average. So now it's a matter of earnings catching up. There may be what some people refer to as an earnings recession, which is the expectation that maybe earnings decline year over year by 4 to 5%. But then if we've learned nothing in the last 3 years through this COVID experience, it's that corporate America continues to prove to be very resilient in terms of optimizing operation, getting earnings back on track, and then ultimately growing again. So think of 2023 as a year of transition, but also think of it as a year of moderation, where extremes become less so, and what was bad becomes mixed, and what is mixed eventually becomes better. So that's really the snapshot of what we see today. As far as the trends and the things that we're anticipating looking at as having an effect longer term on economies globally and markets by extension, one is labor supply and labor tightness in the United States. We think and anticipate that that is going to continue to be a phenomenon that doesn't go away. Labor force participation is still relatively low. It has improved recently, but we expect that that will continue to be a function of the baby boomers retiring, and also people very slowly still not coming back to the workforce as quickly as we had anticipated during COVID. Another major theme that we're focused on is China, not just reopening, but China has an extraordinary demographic problem, which is to say that it's aging. At the same time, their labor supply is shrinking, which is driving their labor expenses higher. So this last 20 years or so of outsourcing to China, it's not over, but it is definitely in the process of starting to change and be less attractive. And when you add the geopolitical elements to what's happening in China, that is definitely something that we think creates an inflationary bias. And then the last thing is around the energy transition, which we think is going to translate to a bias again towards more inflation in commodities, not just in fossil fuels because of the lack of investment in that category, but also a lot of other commodities that are related to clean energy, battery manufacturing, et cetera. So the bottom line is our economics team branded this inflationary vortex, which they called it. So I looked at that and I said, wow, vortex, that sounds dangerous. So I inquired a little bit more about this, and the summary point is vortex is higher inflation, but in the 3.5% to maybe 4.5% range. That is not a terrible scenario. The target is 2, but vortex would lead me to think high single digits, but that is not the expectation that we have. So what we're anticipating is more of this transition that I described, lower inflation, but still above trend for all the reasons that I just discussed, but eventually a return to more normal trend growth rates of 2 to 2.5% in the economy. So it's not as bad as everyone might have you believe, but there are still things to be done to make this better. So I will stop there to make sure we stay on time and open it up to any questions. If anyone on any topic, I like to think of this as the Prime Minister's questions. So anything you would like to throw at me, you're welcome to.
Hi, I have a question. If we go back to mortgages, our institution, I work for Members First. So our institution has been hearing that, and you had mentioned right now it's about 5.5, between 5.5 and 6, maybe somewhere in there.
Yeah.
What we've been hearing, and I'd be interested to hear your take on this, is that at one point you were down at the 2%, maybe 1.8, interest rate at the very lowest, and it stayed there far too low, far too long, and people kind of became a little spoiled with that. And so now that I think back, my parents bought their house and it was like 12%, you know what I mean? So it's 5.5 isn't really that bad. Where do you feel that it's going to taper off? And maybe for how long are you feeling like it's going to stay there?
Well, it's a great question. There are two parts to that question. One is about Fed policy rates, which have created an inversion in the yield curve. And then there's the rest of the curve, and mortgage rates are more influenced by the 10-year, which is right now about 370. So the money is no longer free, but it's still cheap. So a 5.5% mortgage is not outrageous. And so a separate but related point is that inflation today at 7%, previously 9%, and in the Eurozone 9 and 10, depending on the country you measure, is what I describe as nuisance inflation. This is not Turkey or Lebanon or Argentina. And these are also inflation rates that we anticipate are going to be relatively temporary. Now, temporary in macroeconomic terms might be 2 or 3 years, but this is not a 1970s style inflationary problem, which is to say we're not going to go back to your parents' mortgage rates. In fact, there's a better argument to be made that long-term interest rates will stay at relatively stable levels or even decline, primarily because there is such great demand for yield. And so there's this disconnect between the short end of the curve, which is now, say, 4 to 4.5%, and the rest of the curve, which is lower. So the trick is, as inflation comes down and the Fed starts to ease policy, and ease doesn't mean go back to zero interest rates, because that's not what they want to do. But even if Fed funds rates go back to, say, 2 to 2.5%, and there's a slight upward bias in the curve, then mortgage rates could stay at these ranges. So if you have, if you're going to buy a house today, I wouldn't change your behavior based on speculating about the direction of interest rates. I certainly don't think they're going to go up another 200 basis points. They may go down a little bit, but buying a home is not something that you want to make a science experiment out of forecasting interest rates. That won't end well. Did that answer your question? Good.
Hi, I appreciate your perspective. I find it highly disingenuous that the economy can reach sustainability, I mean with a capital S, when when the environment and social issues are not taken into consideration, since everything has to be produced by things that are here on Earth, at least for now, which has reached the point of diminishing returns, and predicated that we need people to produce such goods, and they're already being squeezed. I don't know how, with a lack of consciousness, the economy can grow equitably unless those two things are taken into consideration.
So you're alluding to environmental social governance. ESG is an enormous phenomenon in the investment world, and it's pervading not just the investment world, but corporate America and organizations broadly. And they're tapping into exactly what you're describing, which is people are attempting, companies and organizations are consciously making efforts to be more thoughtful about resource utilization, environmental impacts, governance questions. There are some people who think that this ESG paradigm should be separated into two categories. Environmental should be its own category. Now, the sustainability that you mentioned that is the essence of the environmental element of ESG. Because when we think about ESG investing, it is all about sustainability. Now, there's a little bit of a tongue-in-cheek response to that, which is that I don't know a business owner today who isn't interested in sustaining their business. But sustainability is not about being in business in 100 years. It's about, can we be in business and be stewards of the environment? Can we be responsible corporate citizens? And can we do business in a way that is inclusive to what you're alluding to? I believe so. Am I capturing that correctly?
It gets, that's about as far as it goes. I mean, there are some companies, yes, and there are like venture capital, what happened to them this week. So, I think they're selling it, I'm sorry, because people want it, but it's going to take a real substantial change in, the way we deal in our economics. And probably it has something to do with how it interacts with our election system to really give it some teeth.
Yeah,
I think you know where I'm going with that.
I know exactly where you're going. And I think there are obviously two sides to this debate. The side that I think I might hear you say is that ESG sounds good, but then there is a real problem with greenwashing, especially as it relates to the environmental part of this. In other words, companies have these initiatives to say, we're going to do all these great things to reduce our carbon footprint. And then when business operations start to falter, they conveniently and quietly back away from those commitments. And so these are things that are going to take time to become part of the structure of how people do business. The energy transition is something that is very real. It's not going away. The electrification of cars is a great example of this. Too many big auto manufacturers have invested too much money to believe that the internal combustible engine is the future. But there still is a parabolic increase that has to happen in terms of making traditional gas engines go away. So the question is, how do we make that transition in a responsible way so that we recognize the realities that, for example, natural gas, still a fossil fuel, but less than half as bad by emissions compared to coal. And this is where policymakers, and this is where I think the politics, and you allude to this as well, are going to be really important, because public policy is going to have a very significant impact on the extent to which this conversion goes in a balanced and moderate way versus turning off all the nuclear power plants. Like Japan turned off all their nuclear power plants 10 years ago. Germany did a similar type of a thing. Those have created shocks to their own internal energy security and supply that aren't exactly the best economic policy. And this is the balance that I think people need to recognize, the reality that we all agree that it would be great not to have carbon emissions. That's not the reality of the way the infrastructure of the economy is built today. So it's going to take time. It's going to take moderation and compromise, but public policy is going to be a big part of how that plays out.
We have time for one more question. Could you just quickly, you hung the crypto carrot out there, so I will definitely bite. My general understanding is that I think if you consider it an asset class, it's like in total $700 billion and a fraction of, the market capitalization of some of our biggest companies in the S&P 500, and wouldn't cause like a cataclysmic event. But I do think the interesting thing is the regulatory environment and how this guy, who incorporated in the Bahamas and didn't have a board and et cetera, is going to be held accountable. And then does that affect sort of our overall digital currency position? So less than crypto, I'm more interested in your thoughts on the regulatory environment. You voiced over political dysfunction. Is that the sort of FTC and SEC, like, can't really get things done? Will anything change?
Well, as specifically as it relates to regulation of crypto assets, a little over a year ago, Sam Bankman-Fried went before a Senate subcommittee that has oversight for the Commodities Futures Trading Commission. And he criticized conventional banks for, and this is, I'm not making this up, for having a lack of transparency, creating bespoke transactions, over-leveraged, and self-dealing. Okay. Does that sound like anything that Sam Bankman-Fried has just done? And so what was so extraordinary about his comments was that he knew that if he could get regulation of any sort, that it would legitimize what he is trafficking in, which is ironic because the impetus for Bitcoin and crypto assets 12 or 14 years ago was to be off the grid. It was to be anonymous. And so to bring crypto assets into a regulatory framework is to say that you're going to bring them into the more traditional financial system, which to me defeats the purpose of being in a crypto asset to begin with, which by its very nature is not a currency, by the way. Notice I'm being careful not to call it a cryptocurrency. It's not a store of value. It's not stable. And it's not even technically necessarily a means of exchange because of transaction fees and ease of use. So it doesn't meet those three basic tests of a currency, but all that notwithstanding, if crypto assets get pulled into the regulatory framework, they will still have people wanting to trade and invest in them. But the volatility will be much less because you won't be able to have the types of leverage that currently exists, because today it's truly just it's a free-for-all. So I think that's all we have for time, but thank you for your time today.